Hey, it's Patrick Moore with Ironclad Wealth Management here, and today we've got part three in our guide on how business owners can save money on their taxes when they get ready to sell. And what we're going to do is we go through the strategies because this is our first breakdown into kind of the individual strategies we mentioned on previous videos. Is we're going to go over the ones that take the most time to set up first and the ones that take the least time to set up last. And so today we've got qualified small business stocks, specifically the QSBS exclusion, which can create, and I know that sometimes it sounds too good to be true, a completely tax free exit from your business legally. Now, as always, this is general information. Please do remember that. I hope you learned something from this, but don't go try and do this on your own. Always speak with your own tax counsel as you consider these options. Now, I'm going to call a qualified small business stock exclusion. I'm going to refer to it as QSBS just because that makes my life a lot easier on this video. But what is it? It was created in Section 1202 of the Internal Revenue Code, and the key thing to note is the word exclusion, which means that you can exclude up to $15 million or 10 times your investment into the business of capital gains when you sell the business. So if you invested $10 million in the business, you could exclude up to $100 million of capital gains in the event of a sale, which is a huge, huge deal. There's nothing like this anywhere else in the tax code. And if you meet the criteria, it is 100% tax free. So what are the criteria? Well, the second most important word in the QSBS exclusion after exclusion is qualified. And the first thing is that the business must be a C corporation. The second thing is that you as the business owner must have received the shares directly from the corporation, not a sale. So if you bought them from somebody, it doesn't count. I'm sorry. Now, the business, when you actually have those shares, when you receive those shares, the assets of the business must have been less than $75 million. And to be a qualified business, 80% of the business assets must be used in what's called a qualified trader business. The easiest way to think about this is to actually look at what's disqualified. And I've got a list of the things here: law, engineering, accounting, financial planning. I know it sucks. And then oil and gas, things that use depletion, hotels, motels, restaurants, businesses. I think one of the easiest catch-all categories is if it's a business that relies on services or like the skills of certain employees, then that's going to got a good chance to be a disqualified business. But you can look into that a little bit more closely with your tax advisor to see if you would qualify. And then there's also a rule related to redemptions. What the IRS doesn't want is they don't want people like selling, getting a portion of their shares redeemed, then reissuing more shares. It has to really be permanent shares from the original issue. And so that's something that if you have had some redemptions in the past, you need to speak to your advisor, because within 2 years before and after, that can disqualify QSBS treatment. Now, I mentioned some kind of like the timing, because another requirement of the QSBS exclusion is a timeline on when you received the shares and then how long you've held them to qualify. So if you look on the far left of the top chart, I've got something labeled the stock issuance date. We've got one period ending in 2009, one period ending in 2010, one period ending July 3rd of 2025, because this was just changed and actually improved as part of the most recent tax bill. So if you've had a business and you've received your shares since September 28th, 2010, 100% of your gain is eligible for the QSBS exclusion. If it was before that, you may only qualify for 50 or 75%. And then until July 4th of this year, you were limited to actually $10 million or 10 times your investment amount, and you had to hold that stock for 5 years. So I'm going to refer a lot to the current rules, but just know that depending on when you received your shares, you could be subject to a different set of rules that make this a little less valuable, but still extremely, extremely valuable. So one of the changes in the second chart here is you can see that if you received the shares after July 4th, there's actually now a shorter holding period. All the other vintages, let's call them, you have to hold the stock for 5 years to qualify. So meaning that you have to kind of determine when you got the stock, hold it for 5 years, and then you can sell it. So if you look at this and we do the holding period, if you've held it for 3 to 4 years, you get a 50% exclusion now. And this is only on the new stuff. 4 to 5 years, 75%, 5+ years, 100%. So depending on when you got it, how long you've held it, your mileage may vary. Now, for those of you listening to this video and considering selling the business, you may be saying, "Well, crap, I'm not a C corp and I want to sell the business. What do I need to do to get this done?" Well, it's not the end of the world. You can convert your LLC or S corp or however you're incorporated, or if it's a partnership, whatever it may be, you can still change to a C corp and start that 5 year shot clock. Now it might be a 3, 4, 5 year, depending on kind of what your time frame is and what percent you want excluded, but you can still make that change. One thing to note is whenever you're converting your business from, say, an LLC to a C Corp, S Corp to a C Corp, you just need to make sure that you reorganize properly and retain the proper counsel, because if you don't do it right, you might get hit with some taxes. So that's step two. And then the third thing to know is that only the post conversion growth qualifies for tax free treatment, meaning if your business is worth $5 million today, you convert from an LLC to a C Corp, that first $5 million will still be taxable because it was accrued while it was an LLC and not a C Corp. And then if you are going to consider this, you need to understand that depending on what you do with your money, how much comes out of the business each year, being a C Corp may result in more income taxes than you would have otherwise paid during those 5 years. So you need to kind of keep an eye on that and say, okay, hey, is the juice worth the squeeze? How much will I pay in income taxes, and will it offset those taxes I'm going to save on the sale of a business? So it's possible, but you need to make some consideration. Now, throughout this series of videos, what we're going to do is we're going to do the Daniels family. I'm just going to say they're based out of Georgia because that's where I live. They own an engineering software company. It's owned by the husband and wife. They're going to sell it for $10 million, and they've got a basis of $500,000. Well, QSBS is very simple. You don't need a complicated chart. Because you're excluding the taxable gain, if you look at the before and after here, this family goes from $9.5 million of gain to zero. It's just that simple. Now, they're at the top end of that $10 million exemption if they got that stock before last year, which they would have had to have, because I'm doing this video in 2025. They would have had to have had it for at least 5 years. They're only eligible for a $10 million exclusion. They're using $9.5 million of it, so they're good. And then you can take the money free and clear, do with it what you want. As we go through our guide to saving taxes on the sale of a business, you'll realize there's a lot of strategies with pros and cons. You get this good tax treatment, but you got to do things a certain way for the rest of your life. That's not the case with the QSBS. You follow the rules on the front end, you can do whatever you want to do. Now, there's also two different ways you can kind of boost your QSBS, and the first is called stacking. Stacking simply refers to kind of like the layer of a cake, meaning that one of the things, if you remember earlier, I said, okay, you can't get these shares in the form of a sale. But what you can do is you do get your own exclusion if you receive them as a recipient of a gift. So if you have a very valuable business, you're looking at it, and you want to gift shares to other recipients, each recipient gets their QSBS exclusion. Now, there are a few exceptions to that, which I'm not going to get into here. Some of them are like family limited partnerships. Sometimes your spouse is kind of shared with yours, so that's kind of a gray area, but I've leaned towards not doing that. And also, if you do this before the day of a sale, like if like the day before a sale, you go to your kids, you're like, hey, here's $15 million of stock. The IRS is going to look at that and say, no, that was purely done to avoid taxes. There was no reason to do this. You can't benefit from this, and that income is assigned back to you, and you pay taxes on it anyway. But in practice, what happens is if you own a business, you get your own $15 million. Let's say there's another sibling you have, you want them to benefit from the sale. They could have their own. And then let's say you want to seed a trust for your child. They could get their own benefit too, as long as it's an irrevocable trust and there's some rules followed there. So stacking simply refers to stacking that $10 or $15 million benefit on top of each other. And that's something you can definitely do. You just got to be careful when you're doing it. Now, the second strategy you can do is called packing, which, I mean, obviously they rhyme. So there's a reason that they're called that. But basically, this benefits you if you're going to be over that $15 million basic limit, because you can still utilize the 10 times limit. So think about it. If you have larger than a $15 million gain, well, If you can take that gain, divide it by 10, whatever that requires to invest it, you might be able to utilize the 10 times basis rule. So it could result in much larger amounts of exclusion. You have to buy additional shares to increase your basis. It raises your 10 times limit. It must have a legitimate purpose other than avoiding taxes, and the IRS may disallow it. But let's look at an example here where the business owner thinks the business is worth $30 million, has no basis in the business. If you look before, well, they would still get the $15 million exclusion, so you can't just forget that. So on this $30 million transaction, they would pay about $3.5 million, which is just north of a 10% effective tax rate, which is still pretty good. And then if you look after the investment, let's say they had to invest $3 million for some business purpose that they have to kind of maybe get ready for the sale. Well, if they do that, their basis goes up to $3 million. So they've got $27 million of taxable gain. The exclusion is now $30 million or 10 times their basis, which means they would pay no taxes on the sale of the business. So as long as you analyzed your options here, you could look at this and exit that business completely tax-free. Now, it all sounds great, but what are the drawbacks? Well, the drawbacks are it's not recognized in all states. Georgia does recognize it for those watching this video in Georgia. But there are other states out there where they're like, hey, we're not going to give this federal government giveaway. We're still going to get our state taxes on the sale of your business. There are certain states, and in the blog version of this, we have a list of those if you'd like to check it out. There are AMT considerations for some of those shares in those first two tranches, so that's something to consider. And the ones that are 100% excludable, there are not. It is time-sensitive strategy. Remember, you have to do 5 full years to get the full benefit, and then starting in year 3, you get 50%. So you do have to plan ahead to make this happen. And as I mentioned earlier, depending on how you're being taxed, that C Corp income can wind up being taxed a little bit higher than your LLC or S Corp, whatever you're using. And then finally, if you have a situation where a portion of your sale is taxable, remember you've switched to a C Corp at this point, you'll have to pay net investment income taxes on the portion that's taxable, which is an extra 3.8% that you may not have had to pay in an LLC or S Corp. So you really just got to look at this and say, okay, what's it look like? Can we make this happen? What are the net benefits? And if you can pull it off, it's a pretty sweet kind of a deal once you get to the end of the finish line. Now, who's the best fit for QSBS exclusion? Business owners who are planning ahead, got multiple years if you're not already a C Corp. That's number one. Now, a lot of people who go out and raise money, they're already C Corps because it helps them raise money, but that's a big thing to consider. You got to be in a qualified industry. If you're not, there's no point in pursuing it. I'd say 3+ years from sale, hopefully 5. And then I think the way to think about the business is because C Corps can have some onerous tax requirements. Well, really what you want to be is you want to be in like a lower annual income business or a business that has a very high valuation, like a very high multiple on the business. Because then what will happen is during that conversion period, well, you've got lower taxes and then you got that high exit value. And so this is something that a lot of tech company founders utilize because they are the perfect kind of case for a business like that. So this is something that you definitely want to consider, take advantage of. But even if you don't fit that exact profile, other than being a qualified industry, because you got to be that, I think it's worth exploring. So how should you structure this? Well, first you got to evaluate if you qualify. Then you got to decide, okay, am I already a C Corp? Do I need to convert to a C Corp? You got to hold that stock for 5 years, at least 3. Remember, but to get the full benefit, you want 5. And then it needs to be a stock sale because if it's an asset sale, you're still going to get taxed at the corporate level. So it's something that you really need to kind of review with your personal advisors. So how do we help? Well, first, we're going to help you review your eligibility, put you in touch with the attorneys who can do that, and then coordinate with those CPAs and attorneys. But before we even get to that point, if we look at it and we think you're eligible, we're going to model out those scenarios for you with and without QSBS to say, okay, how much I'm paying in taxes this way? If we don't make any changes, how much will I pay option 2? Is it worth making the changes we need to do to make this happen? That's our job. That's what we do to help you benefit long-term from this. And then if it does look like it makes sense, we're going to create a proactive 3 to 5 year strategy to help you get there. Now, the other thing is, it may not make sense. Well, our job is to review this and other strategies, and we do it working for you. We have no interest in whether you do QSBS or not. It's all about what the numbers look like and what you need. So if that sounds like something you like, schedule a consultation. We do a 15-minute, no obligation, no cost intro call. So just follow that link, get in touch with us. And if you have any other strategies you're interested in. Like I said, this series is going to have 7 strategies, 2 intro blogs, and then 7 strategies. So if this one doesn't work for you, check out some of our other videos, and I hope you have a good rest of the day.